Public pensions face many economic uncertainties in 2018. To best navigate the volatile economic seas in the coming year, pensions will need answers to these uncertainties. Joining this morning are Bernie McNamara with J.P. Morgan Asset Management, Ronald Temple with Lazard Asset Management, and facilitated by Doug Mosely of NEPC. Our panel of experts will offer insights on these questions and provide forecasts for 2018. Please welcome the Economic Outlook panel.
Thank you, Kathy. So it's been a very interesting year so far to date, with the public markets up and down, both equities and fixed income posting negative returns in the first quarter, and volatility really picking up. We're fortunate today to be joined by two very senior investment professionals from Lazard and J.P. Morgan. On my left is Ron Temple, who's a managing director at Lazard Asset Management. He is co-head of the multi-asset group there, as well as head of U.S. equity, and he also serves as a portfolio manager. And so Ron's going to bring the perspective of the public markets. And on my right is Bernie McNamara, who's also a managing director at J.P. Morgan. He is head of the investment solutions group within the Real Estate Americas team. So I think we're going to have a pretty healthy discussion, and I'm going to jump off with a kind of a broader question that I'll pose to both of you. Maybe I'll start with Ron. The economy. Everyone's talking about interest rates and inflation, and what the outlook for both will do to central bank policy and whether that will change, and then the effects of things like the Tax Reform Act that was passed in December in the U.S., as well as some of the trade policy initiatives that have come down the pipeline from the administration so far this year. So when you think about the U.S. economic expansion that has been going on for quite some time and seems to have accelerated more recently, what's your outlook, and what do you see kind of taking place in the next 18 to 24 months?
Great, thank you, and thank you again for having us here today. I would start off by saying, as it relates to the U.S. economy, I remain pretty optimistic. When I look at the U.S. growth story, I've been optimistic for the last 3+ years, and I would preface all of this in putting in context. I believe we entered the third phase of this economic growth cycle in around 2015. So I tend to define the first phase as 2009 to 2011. We were basically just stabilizing the patient. We had quantitative easing, we had fiscal stimulus from the federal government, we forced our banks to recapitalize and again stabilize the economy. So you could call it basically recovery, but it was really stabilization. Stage 2 was 2012 to 2014, which was more quantitative easing from the Federal Reserve. We basically had corporate profit recovery, and we had financial asset values go up a lot, which created wealth effects where the richest people who own the financial assets basically could spend more money and were more confident because their balance sheets had recovered quickly. What was missing in that first 6 years was the middle class. So if you effectively think about it, we looked at unemployment rates. They were coming down, but there was no wage growth. Home prices didn't bottom until 2012. And so for the average middle class household, they kept looking and saying, what economic recovery? Now, I believe in 2015 that transitioned, because by 2015, home prices had been recovering for 3 years. The labor market finally got tight enough that we started to see broad-based wage gains across the income spectrum. So when we do the analysis since 2015, at every part of the wage spectrum, there have been wage gains net of inflation for the first time in 8 years. And so what I believe is happening is actually that middle class momentum was gaining speed when we got to the 2016 elections. Now, all of this optimism, by the way, was before the elections. So I believe whoever would have won the presidency was inheriting a pretty good story in terms of gaining momentum. Now, you throw some fuel on the fire with a big tax cut of $1.5 trillion of tax cuts over 10 years. And by the way, I think probably more importantly, in February, Congress passed a $390 billion spending bill right after cutting taxes. You put those together, you've got basically a recipe for momentum for at least the next 1 to 2 years. Now, I was optimistic before the tax cuts and the fiscal stimulus. I'm more optimistic about the short term because of those tax cuts and spending. But I'm also more worried because I think it gives the Fed more latitude or more of an argument to basically say, wait a minute, this economy might be running hot. Let's raise rates more. In fact, even over the last 36 hours, one of the Fed governors has come out and said, maybe we need to raise rates more quickly than we thought before. I had the pleasure of meeting with Janet Yellen a couple weeks ago in a small group setting, and she actually admitted that she thinks if she could change anything, she thinks the Fed might be behind the curve and should have started raising rates more aggressively had they known there would be these tax cuts and spending. And so I do think that the economic outlook, at least for the next 2 years, is good. I think we could probably pull off another 3 years of growth, but I'm more and more worried that the Fed might be the biggest risk to that story because they're going to see more wage pressure, more inflationary impulses, and might hit the brakes a bit too hard on the economy. Just quickly, 2 other things I worry about. Protectionism. I do think the trade policy disputes we're seeing right now are basically very destabilizing for business planning. So one of the benefits of the tax cuts was we basically sharply reduced our corporate tax rate. We gave immediate expensing to any kind of capital expenditures or investment by companies. But the problem is if a company doesn't know if their supply chain is going to have a tariff or not next month, that makes it really hard to make plans. And by the way, yet again, you probably saw over the weekend, the U.S. seems to be maybe doing an about-face on selling products to ZTE, one of the Chinese telecom companies. That kind of uncertainty actually can offset some of the momentum we've seen from the tax cuts and spending. So I worry about that destabilization. And the third thing I do worry about still is geopolitics. I think the Korea situation is not over, in spite of everyone falling in love in the last 2 months. I'm not convinced. This is not Tinder. But I look at this, and it's really worrisome. And I also worry, by the way, about the Middle East. I think there's a lot of change going on in Saudi Arabia. I think the Iranian situation is actually becoming increasingly volatile. And I do worry that that is an underestimated source of potential risk for the economy globally.
Great, thank you. So Bernie, what's the view from JP Morgan on the economy and central bank activity?
Yeah, not to make for an uninteresting panel, but I agree with a lot of what Ron was saying. The U.S. economy continues to grow. We're in the 9th year of an economic expansion. One of my colleagues, our chief global strategist, Dr. David Kelly, likes to refer to the current U.S. economy as a healthy tortoise. And I think that's a fitting metaphor because the U.S. economy continues to grow slowly but steadily. And I think, if anything, this year that the tortoise will pick up some speed. Things were already going pretty well coming into 2018. Now, as Ron said, we've got the fiscal stimulus in the form of big tax cuts and more government spending. So we could see GDP growth accelerating up to 3% through the end of the year and some way into 2019 before it comes back down to maybe the 2% level that we've seen during the expansion. And I would say the reason for that going up and then coming back down can be seen in the unemployment rate. As we know, the unemployment story is broadly a very positive one for the U.S. economy right now. Dipped all the way down to 3.9% in April. During the peak of the recession, it hit 10%. That 3.9 is as low as it's been since the late 1960s. And so again, we see growth accelerating up to about 3%. That should push the unemployment rate down to, say, 3.5% or so. But beyond that, it's hard to see how you can push it much below that. And so I think, candidly, a lack of available workers on their own could cause kind of the deceleration in the middle part of 2019 and beyond. So bottom line is we may see 3% growth, but I think it'll be 1-3 followed by a string of 2s.
By the way, if I could pile on a little bit more on that. On the job front, I think that's important about the lack of available workers. It's interesting, the JOLTS data is one of the reasons I'm more optimistic on the economy than I think many of my peers, is if you look at the JOLTS, it's the job opening labor turnover survey that comes out from the Labor Department every month. Last month, we basically hit a new record high in terms of the percentage of jobs in the U.S. that are unfilled. It's around 4.2%. There are over 6.5 million vacant jobs in the U.S., which I think feeds into exactly what you're just saying about there's going to be more pressure for employers to pay up. It's really interesting, by the way, that same survey looks at the percentage of people who quit their job voluntarily to go get a new job, and it's roughly in line with the pre-recession levels, even though we're at record high openings. I think part of the reason for that difference is employers haven't paid enough to make it worth quitting your job and go get a new one, right? No one here is going to quit their job for a 5% raise, 15%, maybe you'll talk, right? And so I think for employers, they're going to have to step up. And if they can't find employees, maybe they're going to have to start spending money on training for the first time in a long time and trying to bring people back in the labor force. Again, healthy, but it adds to inflation pressure.
Is Lazard hiring?
We are hiring, in fact. Sorry.
So it sounds like wage growth may be a big part of the inflation story.
Yes,
Is that
yes.
fair? So when you think about central bank action, I know in the U.S. the talk is about 3 times versus 4 times. But when you think about, the glide path, over multiple years, where do you see cash rates going? Do you see any potential for the Fed to change their approach to running off their balance sheet? I know they had a big announcement over a year ago that kind of set the map for doing that, and the market seemed to react positively to it. What do you see in changes in central bank action that will glide us?
For the first time in about 4 or 5 years, I think the bond market might be too optimistic about the level of interest rates. So if you think about over the last 7 or 8 years, the Fed has been telling us every year, we have this nice normalization path where Fed funds rates are going to go up over time very gradually. And the bond market never believed it. The bond market always had a lower Fed funds expectation or forecast than the Fed itself. At this point, the bond market actually still has a bit lower than the Fed forecast from their own, the Fed governors. And I think the Fed governors really mean it. So let's put all this in summary. About 6 months ago, I would have said I thought Fed funds would top out around 2%. Now I actually think 2.5% to 3%. I think the Fed really means it when they say 3%. And I think, again, they have a justification because of how well the economy is going. If the Fed funds rate goes to 3%, there's a lot of debate amongst economists and other people in the markets about what that would mean to the shape of the yield curve. I tend to think, that based on my own experience trading fixed income back in the 90s, that we could well see a 10-year yield that heads up towards 4%, which, by the way, I think is probably a bridge too far. I know last week there was a lot of press about Jamie Dimon saying we should prepare for 4% 10-year yield. His comment was that the market would be fine with it and the economy would be fine with it, because if we're going to 4% because the economy is strong, that's all good. I personally don't think that's necessarily the case. When I think about higher interest rates, I think about 2 feedback loops in particular that really matter. Number one is housing. And so I mentioned before that middle-class consumer and wage growth and house prices. If mortgage rates go up 100 basis points or 1 percentage point, that means for your new first-time home buyer, their monthly payment is 13% higher than it was at 1% lower on mortgage rates. So say that again. If you go from a 4.5% mortgage rate to a 5.5% mortgage rate, the cost of buying the same home goes up 13%. Well, that basically prices out buyers. It basically reduces home price appreciation. And when you reduce home price appreciation, you basically impair middle-class balance sheets and make them less wealthy. When they're less wealthy, they're less confident, they spend less, you get fewer jobs. And so number one is housing. But number 2 is the federal debt. The other risk I didn't mention earlier is deficits. I do think this supposed fiscal conservatism that I heard about for the last 20 years doesn't exist. With these tax cuts and with a spending increase, this Congressional Budget Office is forecasting a $980 billion deficit in fiscal 2019. That's the 12 months ending September 30th of 19. I think they're too optimistic. They're projecting 3.3% real GDP growth this year, which no private sector economist is forecasting. So I think you're going to see a $1 trillion plus deficit next year, going higher over future years after that. And so the other big feedback loop is we've got $21 trillion of federal debt outstanding right now with an average interest rate of 2%. So if the Fed goes to 3% on Fed funds and the 10-year yield goes to 4%, you gradually basically have bonds mature and get refinanced. Your interest expense for every 100 basis points is another $210 billion of interest expense for the federal government. And to put that in context, that's more than the budget of the entire Transportation Department, the Education Department, the NIH, and the FDA combined. So you're talking about basically needing to eliminate entire government agencies to offset that spending, which obviously won't happen, which means you could end up in a vicious downward spiral of bigger and bigger deficits. And so I do also worry that that's something we have to think about, and that's why I think if the Fed really goes to 3%, we get into some thin ice in terms of skating on thin ice.
And I assume we could have some of the same effects at the state level as well, right?
Yeah, it definitely is painful for the states.
So Bernie, maybe switching gears from, Ron talked about the residential real estate market and the impact of rising rates. What about the commercial real estate market and the real estate market that JP Morgan operates in and building the funds that a lot of the clients in the room are invested in?
Sure. There's no question that we're in a more mature phase of the U.S. real estate cycle. We're 8+ years since the trough in 2009. U.S. commercial real estate, no question, has gotten more expensive during that bull run. If you look at take core real estate as an example. So core real estate, think the best buildings in the best locations, a well-leased office building in Manhattan or Chicago or San Francisco. Cap rates, or effectively the yield that investors earn on those kind of investments, have come down more than 300 basis points since the financial crisis. So everything kind of feels sort of expensive. But I think a key question is expensive versus what? If you are asking, is U.S. core real estate, in this example, expensive versus itself and the kind of opportunities that we were seeing immediately after the financial crisis? The answer is no question, yes. 2016 and 2017, for example, those were the first 2 years since 2010 that the U.S. core real estate fund index, the Odyssey index, delivered less than double-digit returns. 2016 was 8.8%, 2017 was 7.6%. So there's no question that returns are moderating in U.S. commercial real estate. But if you look at the return spread or the return premium that real estate investors are currently earning versus various kinds of fixed income, whether it's the 10-year or triple Bs or high-yield bonds, if you look at what investors are earning today versus what they were earning in, say, 2007, which was the prior peak of the real estate market just before the financial crisis, the punchline is that this is not 2007. Spreads are much healthier now, implying that investors are being compensated more and being compensated more fairly from real estate. And our expectation for 2018 is, a total return for core real estate in the range of 6 to 8%, which is certainly down from the double-digit returns that pension plans were enjoying post-financial crisis. But I would argue that 6 to 8% is what core real estate is designed to deliver over the long term, with most of that coming from a steady income that's higher than investors are getting from fixed income, with some capital appreciation, equity upside potential. So we're not predicting imminent doom for commercial real estate, particularly because by and large the real estate fundamentals underneath are relatively solid, but we are in a return to more normalized long-term returns.
Great. Well, so we've heard about some optimistic things happening with the tax cuts and GDP growth. Let's switch gears and talk a little bit about the equity market, Ron. If I'm a CEO and I'm happy about my tax cut, I've been buying back stock, I had a period where low interest rates were at my back. Now I'm looking at higher rates and potentially higher wages and a lot more uncertainty with some of the trade policies. How do you see the equity market kind of pricing in the reaction to that over the course of the rest of the year?
Yeah, I'm actually still relatively optimistic on equities. I would say I'm optimistic on the economy and cautiously optimistic on equities. Maybe that's the better way to put it. It's interesting, about 6 months ago when we talked about the valuations of the U.S. equity market, we were trading at about 19 times forward earnings. But because of the tax cut and the earnings growth we're seeing from the economic momentum and the corporate profit momentum, we're basically down to a 16 forward multiple right now. So the S&P 500 is at 16 times 12-month forward earnings. The 10-year median for that metric, so looking back over the last 10 years, the median level was 14 times. So we're at a 2 multiple premium to that history. It's a little expensive. And by the way, I think if you look across pretty much all financial assets, I think Bernie would probably agree, none of them are cheap, right? I can't find a single cheap asset class in the world, okay? Now, you can find cheap individual securities, but broadly based, all of these markets are expensive. So the U.S. is at a 2 multiple premium to its history. The MSCI Europe is at a 2 multiple premium to its history. Emerging markets are less than a 1 multiple premium. And Japan is actually the only major market that's trading cheap to its history. It's about 1 PE multiple cheaper than its 10-year median. So when I look across the equity markets, I see a pretty optimistic picture because the economy is good, corporate profit growth is good, valuations are not cheap, but they're not extremely stretched. And so when I think about this year in the U.S., I think it's pretty reasonable to expect that we could have a high single-digit return on U.S. equities, even while earnings growth is around 17, 18%. And again, part of why I'm saying earnings growth well above share price appreciation is we came into this year with stocks pretty expensive, pricing in an optimistic outlook for tax cuts. So effectively, we're earning our way out of an expensive valuation on U.S. stocks.
What about debt levels on the corporate balance sheets?
You know, it's funny, we've done a lot of work on that. If we look at corporate debt relative to US GDP, it actually hasn't moved very much in the last 10 years. Corporate debt was not the problem in the financial crisis, to be very clear. And basically, even though corporations have borrowed a lot of money to buy back stock, the overall corporate debt picture doesn't look too bad. Now, we've also done layer 2 of that analysis and said, well, wait a minute. Some of the corporates have a ton of cash, like Apple, Intel, some of the big tech companies and pharma companies that had the $1.5 to $2 trillion sitting offshore. What if we stripped out the 20 companies that have the vast majority of that money and said, what about the rest of them? And the metrics still don't look very bad. The one part of the corporate universe I'm more worried about, and we've just started doing the work on, is in the private corporate space. I mean, you've had a tremendous amount of money invested in private equity over the last decade, because, by the way, you know, there's this view that private equity never loses money. That all worked out well last time. And so, sorry, whenever things never work. Anyway, so we look at private companies. I'm a bit worried that we've got a lot of leverage that's been deployed into these companies to increase the returns of private equity funds. And I'm a bit worried that there's maybe too much leverage that's been taken on at extremely or record low interest rates. And when rates do actually normalize someday, that might be one of the areas where we see more problems. I should also note part of the corporate tax reform also reduced the deductibility of some of that corporate interest expense above a certain percentage of EBITDA, at 30% of EBITDA. And so I do think there's a risk around private corporate debt, but I'm less worried about the public market at this point.
So you want to
Well,
comment as well?
I was just going to chime in, maybe interested in your opinion too, Ron, on the tax cuts and whether, at least on the corporate side, it's a little bit of a one-hit wonder this year, right? There's no question that the tax cut for corporations has been directly beneficial to earnings. Cutting the corporate tax rate from 35% to 21% has been a boon for American businesses. And our projection is maybe even a little bit more optimistic than yours. We could see earnings growth year over year being somewhere in the range of 25%, but then moderating back down next year to sort of the 2 to 3% range. And that's in large part because the tax cut in 2019 doesn't look any better than 2018. Also, we've got higher wages, higher interest rate, a little bit lower nominal GDP growth outlook, all of which tends to squeeze margins on the corporate side. So the tax cuts could have the benefit of boosting corporate earnings and I would say overall GDP growth up to a certain level, but it's a bit like a late cycle sugar rush that's going to wear off with growth moderating after that.
Yeah, well, I think just to respond to that, what's not clear is what this will do to long-term corporate behavior, right? In theory, you know, just to step back, I mean, I was all in favor of corporate tax reform, but just a little context. The total corporate tax, well, the total job act, Tax Cut and Jobs Act, I think they called it. They always have good names for these things. Basically reduced federal revenue by $1.46 trillion over the next 10 years. $310 billion of that was corporate taxes. The other $1.1 trillion of it was basically personal tax cuts. And so I think what's kind of lost in the noise was this was a very large tax cut for high-income individuals. If you look at the line items from the Joint Committee of Taxation, $630 billion of the cost was getting rid of the alternative minimum tax. Well, that tax only kicks in if you make over $100,000 of adjusted gross income. And so effectively, that's the top 20% of American taxpayers was 40% of the cost of the tax cut. Another $70 billion of the tax cut was raising the estate tax exemption. So if any of us had died on December 31st of last year, we could have left $5.5 million tax-free to our heirs. If you died on January 1st, you could leave $11 million tax-free. Now, to give you a sense, 0.0001% of Americans paid that tax in 2015, but doubling that exemption from $5.5 million to $11 million was $70 billion of deficits. So when I look at this, I would agree with you. I think the corporate element is what we get highlighted in the news all the time of basically bringing jobs back and bringing CapEx back. But the real meat of this tax cut was high-income individuals, okay? So part one is that. Part two is, on the corporate side, I do think it can lead to more productivity growth. I just wish we would have stopped with the corporate piece of it and only had $300 billion of deficits, because I think having a 21% tax rate means you're more likely to say, okay, there's no need to basically go to that tax haven in Ireland or that other tax haven offshore because I don't have to pay as much in tax here. Part two is if you can expense all your capital expenditures in year one, there's also an incentive to basically invest money in the US. So what I'm not sure of is how that's going to balance out against what you just said, which I think is entirely true, which is you're in year number 9 of an economic growth cycle, right? Not a lot of CEOs are chomping at the bit to put money to work when they know that next recession is either 2, 3, or at most 4 years away. And that's not when you want to be putting money to put plant and property and equipment on the books.
Yeah, no, I think that's right. I mean, the 100% expensing of capital spending clearly, in theory, encourages CapEx investment, but an open question is, will corporations actually invest, or will they continue to just buy back shares or maybe raise dividends a bit or sit on the cash?
My personal bet is they're going to buy back their stock and pay dividends. The other thing, they did get a lot of PR in January, was they basically gave one-time bonuses and raises. My background, by the way, I joined Lazard in 2001 to cover banks. And so I tend to watch the bank announcements. So US Bank, one of the biggest banks in the country, announced a $1,000 one-time bonus, right? And a lot of the banks did that and got a lot of headlines. Well, they have 60,000 employees, which means they paid a one-time bonus of $60 million. Their tax cut was $600 million per year, right? So you got a one-time 10% payout, but you basically got a lot of retained earnings and buyback. The other ones you saw, some of them raised their minimum wage to $15 an hour. Well, that's about $30,000 a year. Most bank tellers make about $30,000 a year in any city in the US. So effectively, it was a nice PR headline to say we're raising our minimum wage to $15, and not many people actually got a raise. So I do think a lot of it's going to buybacks and dividends, which again is better than having it sit offshore in a bank account, but it's not clear how much growth that's really going to create.
Let's switch gears a little bit. We talked a lot about the U.S. What about outside the U.S.? Central bank activity there in Europe and maybe in Asia seems to be on a little bit of a different pace. What do you guys see in Europe and Asia?
Sure, yeah. I think, maybe I'll start, Ron. The ECB in Europe seems to be telegraphing that they'll begin tapering their quantitative easing or asset purchase program around the September timeframe, with an end of purchases perhaps by the end of the year. We'd project that they'd start hiking rates in the middle part of 2019. In the UK, the Bank of England voted last week, just on Thursday, to keep UK interest rates the same and to keep its asset purchase program unchanged. I think that suggests that the Bank of England doesn't quite feel like the UK economy is steady or stable enough to handle higher interest rates. I think that's partly informed by a little bit more sluggish growth in the first quarter than they had anticipated or hoped for. The Bank of Japan seems to be telegraphing that they're going to maintain yield targets for the foreseeable future, also their asset purchase program. So I would say, globally, central bank policy does seem to be normalizing, if you will, but given relatively low rates of inflation across the globe, it's happening at a kind of very gradual pace.
Right. And so I don't know if you share your view, Ron, and maybe talk about the dollar and what the dollar's been strengthening.
Well, on the central banks, I would generally agree. I mean, I think it's important. It's interesting to note, by the way, the ECB, the European Central Bank, last year, they bought 750 billion euros worth of bonds, which was more than all of the issuance of government debt in the entire Eurozone. So effectively, they were buying up everything being issued plus some. As of January 1st, they downshifted quite a bit. And so this year, they should buy somewhere between 270 billion and maybe 340, 350 billion. And the reason there's a range is we don't know what they'll do in September, because they've announced they would buy basically 30 billion a month through September. So what's interesting is, in spite of basically downshifting by 400 billion euros a year in terms of purchases, interest rates in Europe really haven't gone up very much, which is a surprise to me. I thought you would see rates start grinding higher, because when you have this monster buyer of bonds kind of fade into the backdrop, you would think rates go up. As of today, over 40% of all the government debt in the Eurozone has a negative yield. So you're going to pay them to borrow your money, which to me is somewhat insane still. I have a hard time getting my arms around that. At one point, we actually had 15 to 20% of the investment-grade corporate debt in Europe had a negative yield. So you would pay a company like Unilever to borrow your money. Now, again, that's beyond the pale for me of why you would ever do that. And so I do think there's a risk around this, is why I want to go into this topic, that right now investors are very confident that the ECB will get this right. In the last year and a half of meetings I've had globally, and I travel around the world a lot, not one person has asked me about the ECB plans and whether they might make a mistake. Everyone talks about the Fed, right? Because the Fed's already in process of raising rates. It's amazing that people are so confident in the ECB when the ECB royally screwed this up in 2010 and 11. They actually raised rates while the US was still basically putting the throttle to the floor, trying to get the economy moving. The ECB thought they saw signs of inflation and started raising rates in the midst of the downturn. They were part of the catalyst alongside the Greek crisis. I mean, it was a mess. And so I do worry that there's room for a negative surprise out of Europe. Out of the Bank of Japan, I generally agree as well that they're likely to stay the course and keep pumping money into the economy. But yet again, I worry that the BOJ chair, Kuroda, has recently spoken a couple of times about when they might need to start normalizing. So right now, it seems that the ECB and the BOJ are going to keep putting money into the system, but there's room for a surprise. As it relates to the dollar, we saw quite a strengthening of the euro and the yen against the dollar in the last year. It's faded more recently. My explanation for that is I think investors in the market tend to try to look forward, and they say, okay, well, we know the Fed's raising rates now, but you know what? The next central bank to raise rates is probably the ECB. So let's get ahead of the curve and basically bet on those higher rates and a narrowing differential between the two interest rates. I tend to think from here on out we're looking at more stable exchange rates. Yeah, they're going to move around, but I'm not making any call for a big move from the dollar, say from $1.19 to $1.10 or $1.30. I think euro-dollar exchange rates probably stay roughly constant. Dollar-yen probably stays roughly constant. So I think the currency is a little less exciting on that front these days.
Great. Well, we haven't talked a lot about alternative assets, and I know that a lot of our client portfolios have healthy allocation to real estate, private equity, and other real assets. Bernie, can you talk a little bit about what you're seeing in the public pension market in terms of what your clients are doing? Are they still increasing their allocations? Are they pivoting within any of the asset classes like real estate to do something a little different?
Sure. So I would say, in general, we're seeing rising allocations to alternatives broadly, real estate and other quote-unquote real assets in particular. And that's just given the challenges that investors have in the other parts of their portfolio. And so advice that we're giving to pension investors and other institutional investors is to try to bring a little bit more science and less art to that alternatives portfolio design. I would say what I mean by that is that historically I think many investors have treated their alts allocations, and candidly managers as well, have treated the alts allocation as a series of individual, one-off, ad hoc investment decisions. Do I like this particular strategy at this particular point in time? And I think that works if you've got 5 to 10% allocation to alternatives. But as that grows to 15, 20, 25%, which is happening for many plans, particularly some of the larger plans, then I think you need to take a little bit more of a holistic, quantitatively based approach to that alternatives portfolio design and use the same language of asset allocation and of risk return measurement that investors have been using for years in the more traditional parts of their portfolio. And that's in many ways hard to do. For example, one of the challenges in the private market alternative space is just the lack of available good data on different markets and opportunities. You can't just go to a Bloomberg terminal and download up-to-the-minute performance information on private market alternatives like you can with equities and fixed income. And so that makes it hard to draw hard conclusions about the performance of different categories, the correlation, how do they behave versus one another and versus the other parts of the portfolio. So that's where we spend a lot of our time with investors, which is trying to bring more transparency and more of a quantitative-based approach to that process. So, for example, we've built up a database of alternative returns. We've got over 200 different performance time series going back about 20 years across alternatives categories, geographies, sectors, subsectors, risk profiles, and then have built a host of asset allocation tools on top of that database so that we can work with investors and with their consultants to design portfolios within the alternative space with the same kind of tools and methodologies that investors use in the overall portfolio. Again, trying to bring a little bit more science and less art as allocations to alternatives become less tactical and more strategic, long-term parts of the overall portfolio.
Well, Ron, I know you run the multi-asset group at Lazard. What are you guys doing with your portfolios in terms of either trying to build more inflation protection or shift the portfolios to take advantage of opportunities?
Yeah, first of all, I think we definitely are, depending on the strategy, looking more at inflation protection because of that growth profile we see. I don't think any of us are looking at this and saying we think inflation is going to be off to the races. For those of us old enough to remember the 1970s and 80s, none of us are forecasting anything like what we saw back then. I think the U.S. economy and the world economy are totally different. If you remember back in the 70s, you had this wage price spiral where OPEC had an oil shock, and then people had cost of living adjustments built into their union contracts across the private and public sector, and wages went up, which meant you had a spiral of prices going up. I don't think we'll see anything like that, but I do think you're going to see a grinding higher of inflation over the next 2 to 3 years as the economy keeps extending this recovery. Now, again, I don't think it'll reach any fevered pitch, but it's worth thinking about inflation protection in your portfolios. We'd strongly encourage that. I think the other thing I would encourage is just stepping back and thinking about asset allocation more broadly, reevaluating the role of fixed income in general. With interest rates this low, I do think, if you think historically, your bond portfolio was supposed to basically go up in value in a recession because interest rates would go down, and that would offset some of your losses on equities. At this point, maybe there's a little risk now with the 10-year yield right at 3%, but I do think the risk is the 10-year yield goes to 4, not that it goes to 2. And so, if you have a move to 4%, you're losing, in theory, around 7 or 8% of the value of that bond. So you'd actually have a net loss on your fixed income. And the reason I'm highlighting this is I think if we were to have the next big sell-off in equities, it may well be caused by a big sell-off in bonds, right? If the economy starts to look like it's overheating again and people get spooked about inflation, we all saw it at the end of January, early February. Bond yields went up more than people had expected. The stock market was down 12% in 10 days. You actually lost money on both parts of your portfolio. So I would suggest re-examining the role of fixed income. You're not going to get rid of it, but maybe you might want a little bit less of it than you had in the past. You might want to consider what the role of emerging market debt could play, because unlike U.S. Treasuries at 3%, if you do local currency emerging market debt, you can be at the short duration part of the curve and still get a 6% yield, which gives you a little less duration risk in exchange for perhaps a bit more credit risk. And again, given where the economy is, that's a good trade in my view. And I would also suggest thinking about the diversification role of fixed income. There might be other assets, not to basically promote your strategies, but I do think real assets are a good idea, but not just illiquid. I think there's a role for illiquid real assets, but also a role that most people haven't thought about for liquid real assets. If you go back 30 or 40 years ago, we didn't have as many choices in the liquid real asset space, meaning listed infrastructure, REITs. We basically can look at, we obviously have inflation-linked bonds. You can also put together, we've done this, a quantitative approach to finding companies that have demonstrated over time an ability to pass through cost increases to their customers. Just to give you a really easy example, whenever oil was at $100 a barrel and you went to FedEx, there was a fuel surcharge because FedEx priced that right on through to you and said you're going to pay more to ship the package. So companies like that globally who can take advantage of price increases and pass them right through to customers. So there are a lot of different ways we can look at that, including as well commodities. And so I would suggest thinking about liquid real assets. And one last thing on the asset allocation front I think is important. As optimistic as I might be on the economy and cautiously optimistic on equities, I do think the risk is that I am too optimistic on some level and that we might be closer to a recession than I think. And that argues to me that you really want to dig into your equity holdings. It's been great to be passive for the last 8 years when the market went up 15% every year and you really didn't need to pick stocks. But whenever market volatility increases and you got to sell off, that's when active tends to often shine. And within your active portfolios, I would suggest you really want to make sure your managers are buying companies that have strong free cash flow, that have really good return on capital and have attractive valuations. Because when you have that downturn or recession, it's those quality stocks that defend when the rest of the market basically does not defend at all and actually delivers some pretty big losses. And so I would want to examine and make sure you got the high quality companies in your portfolio. They can still deliver the upside if the economy does well and the markets go up, but they're going to defend you better if the economy turns.
Yeah, I think that kind of hewing towards quality applies certainly within real estate as well. We've heard from a lot of investors and actually seen a lot of managers saying the same thing, that, well, I got used to those, as we were talking about, double-digit returns just from core real estate, and now that those seem to be a thing of the past, I'm going to move out the risk spectrum and do value add or opportunistic, things like long lead time, ground up development projects, so that I can get the return that I was getting from the more conservative core execution. And our view is that if you have the perspective that core is sort of quote-unquote expensive, and that we're later in the cycle, you should be much more worried about doing value-added and opportunistic, because if you're doing a ground-up development project now that's going to deliver in, say, 4 years, that could be delivering into a very different economic environment than we're in today. So our recommendation now is to be more core and sort of less risky. I agree with your points about needing flexibility within the fixed income bucket in a rising rate or even an unpredictable rate environment. I think within the liquid alternatives universe, that argues potentially for having exposure to more go anywhere, absolute return type of fixed income strategies that have the ability to do some more tactical sector rotations, potentially even moving to more quantitative-based strategies in the hedge fund space, even though I know that that's become a bad word these days. Within the private markets, on the kind of fixed income side, there's obviously private credit. A lot of capital has been flowing into down the fairway direct lending. I think at this point in the credit cycle, there might be more opportunity and more kind of niche or complementary or diversifying exposures, whether that's on the asset sale side, for example, buying performing loans off of European banks that are increasingly looking to shed non-core parts of their portfolios, or on the loan origination side, more specialty finance kind of strategies. We talked about inflation. I do think real assets have a role to play there, both real estate and in particular infrastructure, both of which have an implicit or explicit link to inflation. On the real estate side, that's because the value of a building is in part determined by its replacement cost, meaning what would it cost to build it today. So to the extent that the cost of construction and construction labor and materials is going up, you would tend to see an increase in the value of a property. The one caution I would add for real estate and inflation is that the ability to pass on those inflationary increases in the form of increased rent very much is determined by the demand dynamic. So if you look back at sort of when inflation really mattered back in the late 70s, early 80s, US real estate outperformed inflation by a wide margin, even though it was high and rising. But if you look at the period of the early 90s, when there was a spike in inflation due to the Gulf War and kind of oil price shock, real estate actually underperformed. And that's because the early 90s was preceded by pretty massive commercial real estate over construction in the late 80s. So it's hard to pass on inflationary increases when you've got a half empty building or an empty building down the street that your tenants can move to. Having said that, the supply-demand story right now is relatively positive pretty much across sectors. You've got pretty low vacancy across office, retail, industrial, and multifamily. Having said that, I would say infrastructure has an even more explicit link to inflation. So for example, regulated utilities, whether it's natural gas distribution, electricity distribution, water and wastewater management, those tend to have the ability to pass on inflationary increases or to the end consumer or to recoup from them as inflation goes up. Likewise with transportation assets, ports, airports, those typically feature inflation-linked contracts where you can have step-up in charges to the end users of those assets as inflation increases.
Great. One more quick question for Ron on inflation protection. In your multi-asset portfolios, what do you typically try to size in terms of a percent of the portfolio that you're gaining exposure to with the multiple inflation-sensitive assets you're targeting?
Typically, our inflation approach in terms is a separate strategy.
Okay.
In terms of basically looking at liquid real assets. But within the strategies, the other strategies that are not dedicated to inflation proofing, we basically look at it and say, okay, let's incorporate the risk relative to debt, relative to equity, and take that into account as part of our analysis. And so that would basically be demonstrated right now through being materially overweight equities relative to debt in most of our strategies that are basically confined to that space. Where we actually have complete latitude, you'll see more exposure directly into those inflation strategies. So those would be, again, including commodities, real estate, infrastructure, inflation-linked bonds, and companies with pricing power. So it's definitely a real place where we've put a lot of thought. And I do think, by the way, if I could just throw out one more point on this, I mentioned reevaluating the role of fixed income. Now, I think for many people in defined benefit plans in the corporate space, if we actually had a 10-year yield at 4%, you had investment-grade corporate bonds with a 5% kind of handle, they're going to be selling equities to buy those bonds. So the other reason I would recommend considering liquid real assets alongside illiquid is it might be a good place to hide until you get that chance to shift your money back into this fixed income space. So it's kind of an interesting tool to add to your toolkit. And that's part of why we developed this kind of approach to looking at inflation protection and diversification. Interestingly, I recently spoke at a conference in Australia with big institutional investors, and it was surprising, by a 2-to-1 ratio, they viewed real assets as a diversifier more than inflation protection. And so it's kind of a different way of thinking about it, is diversifying your risk and also getting a little bit of an inflation hedge against it.
Yeah. And I would add that I'm not one of those purists on either side of the debate, either 100% liquid real assets or 100% private market. I think there's room for both, particularly around what you're describing as kind of a staging portfolio or springing strategy, where you can have some liquid dry powder in the real asset space to take advantage of dislocations that you may see in the market. And I think it's just makes good sense to have some liquidity in your real assets portfolio over the long term.
Great. Well, we're going to open it up for questions in a few minutes, but I'll ask one last question of both panelists. When you look at the landscape, are there any investment ideas or asset classes, sub-asset classes that you think investors aren't paying enough attention to that they should? Maybe we'll start with you.
I'll give my shortest answer so far. I think the liquid real asset inflation proofing space, because if I always try to think about probabilities. My base case is things are pretty good, that we can pull off 3 more years of growth in the U.S. There's a left tail scenario, the negative scenarios, that the Fed basically hits the brakes too hard and the recovery ends sooner than I expect. There is a right tail scenario that's also kind of negative, but that the economy grows too fast and you end up with more inflation than we expect, and that everyone's surprised by the inflation and bond yields go higher than I expect, and maybe that the Jamie Dimon quotes are right and that the economy's just fine and the 10-year yield goes to 4 or even 4.5 or 5. Well, that's where I think that inflation proofing is also pretty important. So I know inflation has not been on anyone's radar for the last decade. I have personally vigorously argued with clients even 2.5 years ago, you're wasting your time thinking about inflation. The biggest worry was deflation. Well, I think we're at a different part of the cycle now. So I think the one area is to think about inflation proofing your portfolio and how you want to do that.
Okay. What about you, Bernie?
Maybe 2 thoughts. One, an asset allocation point, one, a more narrow opportunity. The first, on the asset allocation topic, I'd encourage investors to think about building in the broader alternatives bucket. I think what investors have done successfully within real estate more narrowly, and that's using core as the foundation of your allocation. By core, I mean investments in underlying high-quality investments that have steady income associated with them and generally lower volatility returns across not just real estate, but other real assets, also private credit and liquid alternatives, which in combination can deliver stable returns through time, an income yield that's a little bit higher than fixed income, and diversification for the overall portfolio. I think that core construct in real estate can be applied more broadly and getting away from kind of one-off individual best ideas allocations. Having said that, a best idea, since you asked, I would say I'd agree with Ron that broadly there are no screaming buys out there on the investment landscape. But I think one underlooked or developing opportunity within real assets is what we'd call yield-oriented transport investments. So by transport, think moving infrastructure, whether that's on water, bulkers, tankers, container ships, car carriers, through the air, aircraft, or on land, rail car, and the like. That's an industry that's in a bit of a transition and in need of new long-term capital providers to the industry, and I think pension plans could make good sense as those capital providers, as recent regulations have limited banks' traditional ability to provide financing and other capital to the industry. And as a result, we're seeing investments delivering kind of 9 to 10% yields with high-quality counterparties on the other side of it. So perhaps not a screaming buy, but an example of a little bit of a mispriced risk because of capital scarcity in the industry.
Great. Well, we've heard a lot of good insight in the markets and asset classes that a lot of the trustees in the audience have exposure to. So we'd like to open it up for questions. We've got about 8 or 10 minutes for questions, and the microphones are being passed around, so we'll just wait a sec till the microphone gets to you so everyone can hear your question. Great.
Thank you. Thank you very much. This is might be a little bit off target, but in the President's opening remarks, he talked about how great pensions are for the economy and for the local economies. And since we are and you are our partners, is there any way that you guys can help us get our message out to the conservative think tanks and how great that public pensions are as a fund and how good it is for the economy, and how if you don't have a pension, in the end, the government's going to be paying for you anyways? So I was wondering if there's some way that we could form, and I mean, you guys are in the industry, you know how valuable our money is, and you know how valuable it is to the community. So I don't have the question fully formed, but I'm just wondering to throw it out there. Thank you.
I could take a quick swing at that. I mean, one of the things we've done, which is slightly different from where you're going, is we've been doing a lot of work on just the retirement savings crisis that I think is coming in America in general. And I think part of it is just education. So every 3 years, the Federal Reserve does a survey of consumer finance. They just put out the data in September for the 2016 survey. And what it basically showed is fewer than 55% of all American households have any retirement account at all. Basically, what you've seen is defined benefit plan penetration has gone down over the last 30 years. In theory, that was supposed to move to defined contribution. It hasn't. In fact, defined contribution participation went down over the last 7 years or 9 years. And so I think what most politicians and even citizens don't realize is, first of all, that half the country doesn't have a retirement account at all. And by the way, this included 401k, DB, IRAs, KIOs, any of the IRAs. So effectively, you got half the country with no savings. And of those households that did have any retirement account, the median level of savings was around $60,000. Well, you're not going to last very long on $60,000 in retirement, right? And so the other data that came out was that the top 20% of retirees by income were the only part of the country that actually had more personal income than they had from Social Security. The bottom 80% disproportionately rely on Social Security, and the few of them who are lucky enough to have pensions rely on that. So I think it's more of an education process to say, you know what, in the next, I think this is one of the biggest risks in the next 20 years is we have a recession and people don't have enough savings and the government has a massive debt. And I don't want to go back to the days when I remember people talking about elderly people eating dog food to try to survive back in the 70s and 80s. And I think there needs to be education to say we've got to prepare for this. And part of it is preserving the safety net of defined benefit in general. I think, it sounded great to say we're going to leave it up to the individuals, but, honestly, you guys know how hard it is to do as professionals. This is not something you leave to individuals and say, figure it out.
Yeah. I agree with Ron. I think that education is the big part of it. When it comes to those specific organizations that I think have had an agenda and I think put out a messaging that is, inaccurate regarding public pension funds, I think that what NCPERS has done and many of the vendors in the room have signed on to is, that agreement that you're not supporting any of those entities, whether they're national entities or state-specific organizations that seem to have a bias and a mission against retirement savings and defined benefit pension funds. I don't know if you have any comments too.
Yeah, no, I'd just add, we've talked a lot about real assets during this session, and you can think of real assets as the fundamental building blocks of productive societies, whether it's real estate where people live, work, shop, store goods, infrastructure, transport, as we were talking about. And some of the biggest, longest-standing investors in those building blocks have been U.S. pensions. And so I think there's a virtuous feedback loop there at a time when infrastructure investment and spending is at the top of many headlines. I think underscoring the role that pensions have played, both domestically, but even looking globally. If you look at Canada or Australia, those pension systems have been very successful in building some of the best infrastructure in the world in those countries. And so I think the two go hand in hand, and we're happy to be a part of advancing that message and mission.
Great. I think we've got another question in the middle of the room here.
Yes, Mary Collins, Washington, D.C. I have a broad question in one sense, and it's tied to the economy. I just want to make the statement that as working people, teachers, police, fire, and other public service workers, we are already struggling and we are under attack as far as our pension plan. But I want to would like for you to address two issues in the economy that is going to have a tremendous effect on us depending on how it comes out. And one of them has to do with immigration and the fact that there are jobs that Americans are just not going to fill. So therefore, you have to deal with that policy. That's one. Because there are small and mid-sized businesses that are going to go out of business if something is not done. I'd like for you to address that aspect. And also the aspect of the tariffs about aluminum and steel, because in the supermarket, there are a whole lot of tin in there in terms of affecting the consumer, which in turn affects the economy, which is, as consumers, we are like afraid. So could you please address those two issues in terms of how it's going to affect us as workers in terms of the economy, if you can?
Great. Do you want to take it for Bernie?
Maybe I'll start with the second question around the tariffs and the rhetoric around a trade war that could result. One of my colleagues referred to that trade war rhetoric that we've heard as a bit like a WWE wrestling bout, a whole lot of trash talk going on, but in the end, hopefully not a lot of damage will be done. That's partly because of the relatively small scale of the measures on either side. So if you look at the U.S. is set to levy tariffs on, depending on the estimates, upwards of $150 billion worth of goods, with a tariff up to a maximum of 25%, and China responding in kind. And those tariffs would apply to steel, aluminum, soybeans, and about 1,000 other products on either side. Now, 25%, the max tariff of $150 billion, is $37.5 billion, which is a big number, of course, in isolation. But put into context, it represents just 0.3% of China's GDP and just 0.2% of U.S. GDP. So relatively small effect. But I think the other more important reason that an all-out trade war is not likely to evolve is that it's just not in the best interests of the U.S., China, or our trading partners. The last time the U.S. Levied tariffs was back in 2002, when the Bush administration applied tariffs to 11 or so steel products. And the response from our trading partners was to apply taxes to Florida oranges, Michigan automobiles, and a host of other exports. And within 20 months, the original tariffs had been rolled off. So I don't think that a trade war is likely to evolve because it's just not in our best interest. One of my colleagues likes to say that a tariff for a tariff makes the whole world poorer, and I think that's true, and hopefully cooler heads will prevail.
And maybe I can just take a swing on the, I would just say, by the way, I think the American people are being sold snake oil. I mean, they're being told that your problems all came out of immigrants and unfair trade. And I do think there has been some unfair trade over the last 20 to 30 years without question. But I worry that no one's disagreeing with that messaging in terms of trade in particular. So I have a bit more pessimistic view than Bernie and JP Morgan in that I think populism is a major political force for the next 10 to 20 years in this country, where we're going to have a swing against some of those globalization trends. And I worry that we will see more tariffs, and this will be negative for global growth and will raise prices for consumers, which adds to that inflation risk. As it relates to immigration, by the way, I do think it's very important to point out exactly what you said. There are many jobs Americans either don't want to fill or can't fill. And I think we should recognize that U.S. economic growth is driven by two things: working-age population growth and productivity growth. Well, when you stop accepting some of the most intelligent, well-educated immigrants who've come to American universities and we basically send them back home with a great made-in-America education, we're just helping other countries compete with us and take that productivity growth. And in my mind, that is not only unwise, but pretty much stupid. Now, part two is there are some other people who have manual skills or manual wage jobs. We should take them in to the extent we need them, and I think we have to find a fairer way of approaching immigration because we're better off with the right immigration policy.